Hey, good afternoon, everybody. This is Dennis Wilborn. I want to welcome you to today's session of On the Market, live market updates. If you're joining us live on Instagram, welcome aboard. If you do have a stock for us to take a look at, please let me know what that may be. I am watching from my other account on Instagram, so if you log on, just please say hi, and I'll say aloha back to you. If you have a stock, as I said, that you would like us to take a look at, let me know. We'll see if it measures up to being on the radar. So with no further ado, let's get to it. There's that handsome guy. Just want to say aloha, everybody. And we'll be clicking off the my video here shortly. One of the things to remember, the market basically got whacked really nicely to the downside. Nicely to the downside. I don't know if we want to use those terms exactly. But we're getting the reset, the sell-off that we were waiting for. And in reality, that's not a bad thing. That is not a bad thing, because oftentimes these 10%, 15%, 20% sell-offs actually turn out to be a wonderful opportunity to start loading up and buying for the next session to the upside. So with no further ado, I'm going to basically put... There we go. Got over to the spiders. And let me get my drawing utensils up, and we will be, in fact, ready to rock and roll. So the first first entity we're going to take a look at is the S&P. We'll let the spiders be the stand-in for the S&P. And so what are we looking at? What's going on here with this particular index? As you can see, a couple of things. Take a look at very, very big range day. It was about 12 bucks or so. We take a look at this. When I looked earlier today, it was about $12. Yeah, $12.12. So that is the largest range that we've had going back, oh gosh, months. And so with that being the case, what can we expect? Well, what does that tell us? Basically, it's telling us that, one, volatility is increasing coming into the markets, which is, which is kind of evident, but also that the market has basically gotten a tendency to want to drive down. We've come back. One of the other couple of key components here, we are closing below the 50-day moving average. That is a bearish signal. Now what I would do is I would change my bias towards the S&P to basically on any rally attempt back into the moving averages, like the 50, the 34, or the 820. So the 820 is also crossed. That would give us an opportunity to short this index. What else are we looking at? One, let's take a look at the Qs, see if it is as ugly as this one. And lo and behold, it certainly is. If you remember correctly, yesterday, I actually drew a projection down from this high to low, and then an extension down to the downside. And as you can see right here, the extension, we just about reached that 296 level, which, and go back to the daily. We'll raise that up, and again, that was measuring from this high to this low, back to this important high here, and price action actually blew down almost to that level, missed it by about $3. And so the Nasdaq is also stacked to the downside. Look at the volume, large selling volume, and so today, in reality, with a big wick on the bottom, a big wick on the top for the selling. It's one of those, kind of toss up. Clearly, we could say that the index is looking for a area of support, and we drew that out yesterday. Look to your left. What do you see? Anytime you see big long candles, big long wicks like we see on this candlestick right here, what do you want to do? Well, you want to look to the left to see, does it line up with a level of, let me get that straight, a level of support where it broke out of before. And lo and behold, it certainly does. It broke out over here, went up, came back, retested, and then went on its surge. When was that anyway? That was back in middle of December 2020, just a few months ago. So we'll be watching the Nasdaq. Again, Nasdaq has been the weakest of the entities. It closed below its 50-day moving average about a little bit of a week and a half ago, did a little bit of a rally attempt, and then is now diving for the deck. Now, on the positive note, look what's going on down here. We are hitting a new low with the price action. However, our momentum indicator is not. Even though we had a kind of a bloody day today with a big sell-off, the momentum indicator is positively divergent. What's looking on the weekly charts? Well, the weekly chart, the TSI is still pointing and broke out of that level of support right there, heading for the zero line. And if we hit the zero line and break behind it, watch for a pull, even additional dropping of this index. I'll wait until the weekend to be able to lay a understanding if price actions stay approximately where they are. Any kind of a pullback into the midsection of this week's candle might be an opportunity to, and that would be right about there, might be an opportunity to go ahead and enter a bearish position to trade the this index to the downside. What is it? What else are we looking at here? We are looking at the IWM. IWM is okay. Basically the reason why the market was kind of diving in the ditch today was Jeremy Powell basically spoke, and he was basically saying that the interest rates, bond rates, that they expect them to be rising as we come out of the restrictions and the lockdowns and business starts to get back to natural. They're expecting inflation to pick up a little bit, and that, guess what? In the Russell, the small caps, do not necessarily like higher interest rates. Why? Because they primarily have a lot more money borrowed, and so any modifications or change to the interest rates themselves really impact them to in a negative direction. So we came right down to a past level of support that I've drawn in here previously, stopped dead in the water, did a nice bounce. Daily chart, TSI, pointing down to the downside, like it's saying, you know what, we're out of here. We are still holding the 50-day moving average, so that's a positive. Intraday, we did break below it, and so if we, in fact, it could bounce and move all the way back up into the moving averages, the 820, or let's say the 217 level, or even the about 216 level, and then roll over from there. That's that halfback principle that we were talking about yesterday. So on IWM, not a lot to write home on about. It's clear that yes, people are coming in and testing the water. I would call it kind of, with any type of significant correction like we may be currently under, there will be points along the way down where buyers will come in and test the water. That may be what's happening here. We've found, what happens is you look to your left. We have a pocket of support. This is a pocket of, on this last consolidation here, this flag pattern, there are still buyers sitting there who basically are unfulfilled, and they want to buy at that level, and oftentimes they will come in and they will basically buy. Price action does move up. However, if this was I won't call it a weak pocket, but once the buyers are exhausted in this area, if they are not enough to push us up to higher levels, breaking out above these past highs here and restart the uptrend, then when we come back down to this level, what happens? There's no buyers for support, and oftentimes price action will slice right through it on its way down to the next level where potential buyers could be at the 205 level, or all the way down to about the, I'll open the window, 199. How far has the index fallen? That's another thing we want to take a look at. From the high to today's low, we're looking at about 9%. So remember, we were after a 10% drop. Where's a 20% drop? Just for shins and grins, so we'll know approximately where it's at. It's right there about the 181 level, or slightly above that. But again, look to your left. What do you see? That's a level of past congestion and a level of support where price action rebounded from there and went on a pretty significant run. And it's very clear. I think this chart gives a very good showing that it's not going down in a straight line. It's just kind of meandering down. And so in actuality, it's a nice controlled sell-off, people taking profits, moving things down. So let's see here. Let's go on over. I want to show a couple of things. One, if you'll recall yesterday we talked about DocuSign, and I'll throw at DocuSign really quick here. And on DocuSign, it did, in fact, continue to sell off. But if you will recall yesterday, I was talking about the half-back principle. And so we did a measurement from the low to the high, divided it in two, and we came up with a number of 224.37. That was the halfway back up into the middle of the range from yesterday's candlestick. Well, what happens this morning? Prices open here. They ran up, look at that, almost into the middle third of yesterday's candlestick. How close did it get to 224.37? It got to 223.98. So, pretty darn close to the actual midsection of that. And that's one of the lessons you can take away from today. If you would have bought yesterday's low, or close to yesterday's low, and you were looking to get out with a really quick profit, yes, you could have gone all the way up to the halfway mark, but sometimes it's a great idea to, yes, that's what the technicals tell us, for a halfback, so you want to go precisely to a half. Well, that sometimes is not the best idea. You want to go slightly inside of that target. So how much is slightly inside? That's where the art of active trend trading comes from. There's the science and the art. The science says you're going to get a half back. The art says fudge inside the half. And so in this particular case, it was about 39 cents worth. And so, what would you have been happy with? Would you have been happy with, if I was $1 short of the 224.37? Oftentimes I'll use that like on a $200 entity. I'll go $1, or so, $1.50, something like that, from my expected target, because I want to be taken out of that position on strength. And so as you can see, if I would have had 223 in here, it would have gone up and hit that. And my from yesterday's low, which was yesterday's low was 216.16. So from yesterday's low to about the midsection, and we'll just grab a hold of this really quick, to about the midsection. Okay, not that far, not that far, not that far, right there. So that's about a 3.54% gain. So that's, that's nothing to sneeze at. That's well, I mean, you can sneeze it if you want to, but you know the old adage. Let's get rid of that drawing. So anyway, I wanted to highlight that to you real quick. Get rid of that. So now let's take a look at a couple of the other stocks that we're talking about. And I want to look at first ZTO. If you're a part of our autopilot trade team, you know that we actually triggered into a trade on ZTO today. We put in that alert. Where did we put in the alert on that? Let's see. We put on the alert on the 26th. But first, we put on the alert on this day here. And we said, hey, if we get down to approximately where it triggered today, we want to get into the trade. Sure enough, it triggered us in today, and now we got a little bit of a rebound. We'll see how that goes, but our stop loss is slightly below that. One of the things I just want to highlight ZTO for is it offers some pretty good option opportunities here. It has earnings coming up, and so you could actually buy the $35 call on this for about $1.25 to somewhere between $1.25 and $1.30, and that is the March 19th expiration date, and it's hitting at about 50% delta, and oftentimes we will get if this does go into a pre-earnings run, it could run up here and along with the implied volatility increasing, go $3-4 and take that out prior to earnings. I always sell them prior to earnings. So that's one of the ones we're looking at. What about another one that we are keeping our eye on? When the market starts to do the crazy stuff that it's doing right now, we also want to be aware of entities that are holding up better than the rest of the market. Google, or Alphabet, if you prefer, is holding up better than the rest of the market. As you can see, the moving averages are still in a buy position. That means they're stacked one above each other. They have not crossed back over. I'm trying to get this down to a level we can take a look at. There we go. It is finding there's some support about the 1992 level, and it's going on up to about the 21-26 level. It is holding up it's holding up better than the rest of the market. It is not sold off. As a matter of fact, it held its position today. One of the ways you may want to approach this is wait for it to come back down here and test at about the 2006 to 2000 level, or even lower than that, 1996. And then you could do a bull put spread or a bull call spread, and then ride it back up the rest of the way. It's already had earnings, so this is good. It is in the process of just basically retesting this earnings gap, and it's working as advertised. Because normally the midsection of the gap up is the strongest level of support or resistance, whichever, depending on the way you're approaching the particular entity. And with the market conditions the way they are, we also want to throw in some potential downside trades. I think PayPal, now that it has broken on significantly higher volume, this is a 50-day moving average on the volume. It is almost 2 times above that on this big sell-off. Now, I'm not going to sell with the TSIs that close to the bottom, but I am also extended so far away from the moving averages, but I will watch PayPal. I'm moving PayPal to my I want to sell this list, my short list, if you will. And so if it moves back up towards the 50-day moving average, which is here, and also the TSI, not the TSI, the 820 and 34 should start rolling down more quickly. Any type of a move back up and into there would give us an opportunity to get short on PayPal I'm not going to short PayPal per itself, but I'll do an option trade on that to the bottom, a bearish option trade. Let's take a real quick look at the fibs. People talk to me about the fibs all the time. And as you can see, we did from there down to there. The 50% retracement is right there at the 255 level. And I want to show you one other thing. And let's see how these Fib extensions, they are so phenomenal. They work really well. Let me move that right. Now I want to do a Fib extension to give us downside targets. So if I go here and go down to that low there, back up to that high, as you can see, normally what I target is the 78% retracement, which is right there, or the 100%, and that would mean symmetry of move, symmetry of this move from here to here. Now, it could still get there, but somewhere the target between the 220 and the 127 extension, 204, those would be my downside targets if I, in fact, get a little bit of a pull-up and then get down to the downside. Speaking of fibs, I'm working on something. If you want to know more about this, I'm working on and I'm calling Fibonacci grid. And they're a combination of taking into consideration both, hopefully that'll come up, there it is, time and price, with the expectation that we're going to get symmetry of move. I can target a zone and a time to be in that zone, and it's working very well to sell covered calls against it. Because what I can do is, like this is the case of Ford. Ford has weekly options, so I can literally go either 50 cents or $1 in the money, because this doesn't move a lot on a daily basis. I mean, or a weekly basis, either one. Today's movement on Ford was 83 cents. So I can basically go, anywhere from 50 cents to $1 in the money, sell that call with the expectations I'm going to drop down here into this level by this time frame. It just turns out that this particular time frame is around 311, which 312 is the end of next week. So I'm looking to sell. I will use the intraday charts to enter, but I'm looking to sell probably about the $11.50 option, or I could go all the way down to around the $11. Sell that with the anticipation if it break, and my stop loss was if I take out this high over here, I would want to get out, and then just let that cook off with the expectation that the probability is better than 50% that prices are going to wind up down here if, again, that is if symmetry repeats itself like it did over here. Now, symmetry may repeat itself where on a shorter phase. That's why I have a little zone there, somewhere between the 78% retracement, $11.39, down to the 100% at $11. And I'll keep you posted on how I'm doing with that particular strategy, because I'm really looking for a mechanism by which I can help people sell their cover calls on some of these stocks like Facebook, like Ford, like Wells Fargo, that they may just have hanging around. They may have a few thousand shares around, and if they could make $1,000 or $2,000 extra per month selling, covered calls, that to me sounds like a really good deal. So, hey, that's all we've got for today. I want to say aloha, thank you, God bless. If you have any stocks you want us to take a look at, remember, send me either a direct message, DM, send me an email, make a comment on Instagram, as this is posted up to Instagram TV, and or over on YouTube, where I'll also post it up later this afternoon, is basically just put a comment down in the comment section saying, hey, not only, Dennis, we really like your stuff, and we're going to subscribe to your YouTube channel, Market Tech Talk, and like it. No. But you can also just put a note down there and say, hey, Dennis, take a look at this. And that way it will be recorded. You'll get to see my analysis. And normally I am on at 1 o'clock Pacific time on Tuesday, Wednesday, Thursday, for On the Radar, where we talk about tech tips, we talk about the indexes themselves, and as we did today, show a couple of stocks that we're interested in and where we're interested in getting in. So aloha, God bless everybody.